Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over. So I was kind of searching to see, you know, what drives stock prices. What are some of the most inflation sensitive assets in a commodity bull market in the commodity sector? And then when I was looking, I found a bunch of charts that I'd like to share with everybody. Um, just kind of things that I saw. I threw it on, in a presentation so you guys can see what I'm seeing. So let's walk through this together. This is the commodity price index to Dow Jones Industrial Average. That's your commodity to stock ratio. The cool thing here is it created a pattern. It's got a 1, 2, and then a 3, and then usually we come up and then we're going to break. And if it breaks the top of this pattern, the commodity, what I'm trying to say is commodities could be setting up this massive break where commodities far outperform everything. And the reason that is we could be entering a period where commodities become a lot more scarce. And worldwide, they're going to be a lot harder to get. Plus, they could go up in price given energy crisis or energy prices increasing. So I think that being in commodities is a very good risk reward bet, and especially from potentially external factors in the future that we're not pricing in to commodities. Here's oil, not bonds, total returns after inflation. Energy stocks, this is from 71 to 81. This was an inflationary period. And this is how things performed during that inflationary period from 71 to 81. Energy stocks went up 73% on average. And the energy, and this is where I like to be, is energy stocks. They're very inflation sensitive. And during this time frame was a very high inflationary environment. We had REITs, which did pretty well, 36%, Treasury bills -6, utilities -9, S&P -16, corporate bonds -23, and treasuries -38. So you do not want to be in these types of instruments in an increasing interest rate environment with high inflation. Energy stocks are the spot to be, and I don't have precious metals. Precious metals did very well as well. So precious metals was another spot that did incredibly well during that time frame. Looking at what I've got here is I have a chart, and this is when assets do very well given certain market conditions. The market conditions is high growth, low inflation, high growth, high inflation, low growth, low inflation, low growth, high inflation. So those are we'll call it market condition possibilities. In a high growth, low inflation environment, stocks perform the best and REITs do very well. Natural resource equities do okay, US bonds, gold, and commodities. So I would say most everything do okay, with the best performers being stocks. So stocks do very well when it's high growth, low inflation. That is a recovery phase of real estate usually. In a high growth, high inflationary period, you'll see that commodities and gold and natural resource equities get pumped up quite a bit. And stocks, although they don't suffer much from here because they have high growth, they kind of don't really perform any different. And then REITs get valued a little bit lower. So in this type of scenario, you want to be in commodities, gold, and natural resource equities. In a low growth, low inflationary environment, everything really just gets hit. And REITs tend to perform the best in this type of scenario. So real estate investment trusts are the best. Stocks get hit. Natural resource and gold and commodities definitely get hit. And bonds do a little bit better in this type of environment. Now, this is the environment I think we're probably going into, a low growth or no growth environment with high inflation. In that type of scenario, commodities, gold, and natural resources do the best, but commodities and gold perform the best because we've got low growth with high inflation. Bonds obviously do not perform well. Stocks get absolutely slaughtered, and REITs they don't do as well. So I think that going into precious metals and commodities is the spot to be. because I think we're probably going into a low growth, high inflationary environment like this one in the lower right. This is the economic cycle. The economic cycle is very similar to the real estate cycle. The real estate cycle is a little bit pulled right before it. It'd go right before this. And it would peak, the real estate cycle would peak here and the economic cycle is right behind it. But they've got a reflation phase, a recovery phase. This is a overheat or the expansion phase, and then a slowdown recession phase. And that's what inflation, if you look at inflation here, it's high when it's in the overheat phase, and it's just delayed a little bit behind it. So when we come through here, and that's right where we're at in the real estate phase, is we're coming into an expansionary phase, and inflation is lagged behind it a little bit. So when we talk about inflation, and when I talk about the real estate market and economic cycle, we are just entering an expansionary phase, and inflation is delayed behind it. And I sometimes said there could be a gap between what they've printed, because this has all been basically man-made money printing with the inflation. It's all artificial inflation. And then this will kick in whenever we go into an expansionary phase, we start building more homes. The inflation is offset a little bit by a couple years. So it's coming. It is coming. So what moves the price of shares? Supply of the shares, demand for the shares, earnings reports, macroeconomic data, market sentiment, interest rates. So interest rates and market sentiment obviously impacts the demand of those shares. And then we've got the supply of them. Earnings reports, yeah, they do. But in all honesty, all of these here on this bottom is really more just the demand for shares given certain market conditions. So how to hedge against inflation if we're going into an inflationary environment? As inflation erodes the wealth stored in each unit of money, hedging against inflation is the attempt to move wealth into assets that resist depreciation, or in the best case scenario, actually appreciate at a higher rate than inflation. So your hedge against inflation, and what people are going to do is when they think that inflation is going to be coming, they're going to move their assets that will resist depreciation, or in best case scenario, appreciate in a higher inflation environment. And one of them that I grabbed was commodities, because commodities do the best under an inflationary environment with low growth. So commodities are a traditional inflation hedge, and gold is often used as a safe haven for wealth during inflationary periods. However, several factors have to be considered before assuming commodities will outperform other possible assets. A good way to gain exposure to the commodities market is through exchange-traded funds that comprise of a basket of different stocks. That's what they put. But commodities are one of the best inflation hedges, and you've seen that earlier in this presentation. We've got real assets here. This is the commodity inflation sensitive kind of performance. Real assets do very well in an inflationary environment. Commodities do very well. Platinum does very well. Real estate does well. Diamonds, gold, collectibles, UK farms, treasury bills do okay, apparently, for financial assets. Cars, houses, palladium, silver, art, US farm, US house, and then underperforming would be large cap stocks, small cap stocks, wine, financial assets, and long-term government bonds. So we want to be kind of up above gold, and above would be the ones that I like for an inflationary environment. Here are real assets offered stronger returns when inflation was rising. So we have commodities with inflation rising do very well. Infrastructure, global real estate, US equities. Non-US equities, inflation would be 4.4. And then US bonds, which is a real negative rate. We don't want to be in bonds. Looking at all-time lows, real assets relative to financial assets since 1925. This is real assets. And what are real assets? Commodities, real estate, and collectibles versus financial assets, which are large cap stocks, long-term government bonds, since 1925. And we can see that over time, we've been going back and forth over time. And here's the 1970s to 1980, where real assets really got kicked in the butt and moved higher here. We've been declining. We've had a little bounce here in 2000 to 2008, and then we've declined all the way to really low areas for real assets relative to financial assets. So, in my opinion, in the conditions, market conditions that are coming up, I think that we should be looking at real assets, which is real estate, commodities, and collectibles at this bottom here. And I think this is going to turn and move on up in a dramatic way. And it ties to where we are in the in cycles. So looking at cycles, I've got this is a commodity cycle. So the red dots, major inflation peaks, blue dots are major inflation troughs. So this is a disinflationary environment coming down, and there are inflationary environments coming up. So we had an inflation environment starting in like the late mid 30s, and then the 40s and 50s and 60s and 70s, ending in 1980 would be the peak here. And then we had a disinflationary environment for 40 years. That's why interest rates went down. Interest rates in this went up. Interest rates went down. And what people are projecting, what someone who did this chart is projecting, is that basically we're down here right now, and we would see an inflationary environment all the way to potentially an estimate of 2045. So we could be in a very large inflationary environment coming up from where we are today all the way to 2045. That's what the projection is on this. And it could be a large commodity boom that happens under that scenario. This is the multi-year booms. The previous commodity super cycles peaked in the late 1970s and 2008. So this is the 2007 or 1970s coming here. We had a peak there. We had a peak in 2008. What I did is I took the tops of these guys and kind of just drew it right across and hit the bottoms of these. And this is kind of your support area. And what I think happened is we came up, we hit our head, and then broke through and ran all the way to the top of the channel. We were in this disinflationary recovery phase coming all the way down, and we came back and found support back at this line twice, and now we're breaking to the upside and could potentially head all the way back up somewhere up here over time, which is far greater and far higher from where we are today. So I think that today we're going, one, we're very cheap in commodities, and two, that we could have a potential large move in commodities over time based off of this type of analysis on this chart. And we're breaking the downtrend, which is always good. Here's the available bandwidth for OPEC oil production spare capacity. You can kind of see how this thing was going back in the last bull market. It was around maybe 2 million, 2.5 million barrels a day, just kind of cycling around it. We've come back up. This was a somewhat strong period for oil through here. And then we had this crash. So they have a lot of spare capacity, and this is obviously way down here now in 2021. We're on the verge of another commodity super cycle, another one that was just looking at a 12-year up cycle, 12-year down cycle, and now we're starting to head back up. They've got it circled. This is the Bloomberg US Global Investors, 96 to 2021. So 12-year up, 12-year down, and they're probably going to see a 12-year up. So maybe 2032, something like that. I'm just taking different areas so you guys can have different perspectives and from articles that I've read and shared. It says we're going to be short of oil before we don't need it in years to come. JP Morgan's head of oil and gas, Christian Melek, told clients on a conference call last week, we could see oil overshoot towards or even above $100 a barrel. Here's the purchasing power of $1 since only the year 2000. This is US cents, not seasonally adjusted. Purchasing power recovers a tad right here in that deflationary collapse, deleveraging. But look at this, guys. This is at 100. We're all the way down at 61 cents from the year 2000. That's ridiculous, the decline in purchasing power over this time frame. So yeah, be careful. They're going to be devaluing this, I think, quite dramatically and even more. So get your inflation-protected assets and hold on to them. Here's projected demand from electric vehicles and energy storage batteries for selected metals. 2021 is right here. Going forward, it is a massive boom in nickel, lithium, and cobalt. these are some areas that you may want to look at, but is a massive boom coming up. What I did is I invested in REMX. That is a rare earth strategic metal fund. They own a lot of cobalt and lithium and rare earths. So that's how I'm playing it. I just have that one ETF. I don't have too many other companies. I have a couple of companies, Appia Energy and some other ones, MP Materials. And I'm trying to capture it mainly with the REMX ETF for those minerals. And I also have other ones like a copper nickel royalty, Nova royalty, and some other plays that I've got. But that's the data I kind of wanted to cover. It's kind of random, give you guys a bunch of different information, touching up a bunch of different topics. I wanted to see like the commodity super cycle. I wanted to see inflation and are we coming into an inflationary period, and what type of environment's coming. And that's why I wanted to share all this stuff with you, with some of the charts, show you that commodities are incredibly cheap. And if we're going in a commodity boom, what are some of the best investments for inflation sensitive things? To me, what I would be looking at, platinum, silver, those two I really like because they're also industrial metals and they're going to be used in a lot of these renewables and EVs. Some of the renewable EV stuff I do think is going to drive a lot of demand for certain types of minerals. So I've been going into those minerals and playing them because they're going to go up regardless in an inflationary environment. This is just adding icing to the cake if they try to use all these minerals for this kind of new EV renewable boom. So that's what I wanted to cover. Hopefully you guys got something out of it. Give me a thumbs up if you guys like the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.